Well, how do I follow that? We have a lot of great information coming at you this morning, and I'm very thrilled to be able to introduce Mike Grundman, who's with the Georgia Department of Economic Development. You just heard about their awards. Mike is the Director of Automotive and Advanced Manufacturing. He's a great friend and supporter of GAMA, a great friend and supporter of the automotive industry here in Georgia, and he is a true indication of always being open for business. I'll let him give you his cell number, but he's always available to us and has helped GAMA, and he's helped a lot of companies looking to locate in Georgia. So please, we'll use Mike as a resource. Mike?
Well, good morning, everybody. It is my honor to introduce our next speaker. He is the Chief Economist for Cox Automotive, Jonathan Smoke. Jonathan's team mines data from all of the different businesses and platforms that are Cox Automotive, which includes AutoTrader, Manheim Auctions, and Kelley Blue Book. What his team does is look for trends and actionable insights on both the retail and the wholesale markets. Cox has been big into big data for a long time, and now they're using or leveraging that deep expertise to go beyond their core businesses and help enable the data-driven transportation systems of the future. And Cox is also one of our original automotive technology companies in Georgia, and that's a sector that's been growing here thanks largely to our talent base in our airport and our central location among the OEMs in the Southeast. Jonathan has served in a number of roles as an economist for various organizations before Cox in the real estate and construction industry, including most recently as chief economist for Realtor.com. Jonathan has spoken at many major events, including the Automotive World Congress, and his automotive insights are regularly quoted in the Wall Street Journal, CNBC, and Bloomberg. Jonathan has a degree in economics from Rhodes College and an MBA from the University of Texas at Austin. So please join me in welcoming Jonathan Smoke.
Thank you, Mike. Good morning, everybody. As the governor mentioned, Cox Automotive is headquartered here in Atlanta, so that means I am proud to call Georgia and Atlanta home. For those of you that aren't from Atlanta, I hope you have been in town for a while this week and have realized just how much we love cars, because our traffic really shows that. So much so, if you were here at the beginning of the week, you might have enjoyed the fact that we actually sometimes have cattle driving during rush hour, especially in this area of town. Now, I'm sure many of you are thinking, I'm glad the governor finished so quickly because I really wanted to hear that economist more than anything. But trust me, it's going to be worthwhile for you to be there. What I've assembled are kind of the key facts that help you understand where we are in the economy, how that's impacting the automotive market, but then some specific trends that are happening that are basically producing some challenges, but also some opportunities, especially as you apply that to the production of vehicles in the southeastern United States. And in fact, I'm going to end with some insights that you may not know about the production of vehicles and just where those vehicles end up in the United States at the end of the presentation. I'm told all of the material that I'm going to be sharing with you today is going to be available through SAC after the event. So if there are pieces that you want to take notes on and can't quite make out from your seats, don't worry, the slides will be available to you, and worst case, you can always email me and I'd be happy to provide them to you. So starting first, looking at the economy, this has been a very incredible year. Thanks to the tax reform that was implemented at the end of last year, we've really seen GDP growth accelerate. We had 4.2% growth in the second quarter. That's the strongest quarter in 4 years. And we are destined to have close to 3.5% at least this quarter, and very likely ending the year above 3% for the year-over-year growth. If you look at the history, it was really looking like that economic growth was slowing down in 2016, and we were approaching the end of a cycle. But thanks to the president's efforts to reduce regulation and then to implement tax reform, we've really seen a boost to the economy, and that means the expansion continues. We will make it to next May, and that's important in terms of expansion, because this will become the longest expansion in history once we get through next May. And the forecasts for next year continue to be solid, very low probability of a recession on the immediate horizon. But when you look at demand for autos, of course, the economic growth is important because it produces very low unemployment, continued steady job creation, and that boosts consumer confidence, which today is at an 18-year high. And as a result, that puts people in a position to be more willing and more able to make big ticket purchases like vehicles, but also other things like houses that are intimately connected to the demand for automobiles in the country. But another perspective that is vitally important to pay attention to is what's happening with credit. And there the story is starting to change a little bit. This chart is showing you what dollar loan originations for automobile loans have looked like by quarter going back for several years. And what we have been seeing for the last 3 years is really a tightening of credit standards. And so while loan growth continues, we had almost 2% loan growth in the second quarter, all of that growth is occurring in FICO credit scores of 720 or higher. And so as a result, consumers that have lower credit scores are finding it more challenging, are finding higher interest rates even than the movement we've seen in interest rates, and that's really starting to impact the pool of buyers in the new vehicle market. Now, the automobile industry is pretty fascinating because if affordability becomes a challenge in the new vehicle market, the used vehicle market is there to take on that challenge. And in fact, that's exactly what we've been seeing over the last couple of years, and you'll see it in the volumes in a second. But the other very important trend to pay attention to is what's been happening with interest rates. And if I had to pick one negative to be worried about the most, is the degree in which interest rates have moved in the last 2 years and how much they're likely to move more in the next 2 years based on the guidance that we're receiving from the Federal Reserve. As it stands today, we've had 4 Fed increases over the last 12 months, 3 in this calendar year, and the Fed has announced they're planning to move forward with another increase in December. So we're up 100 basis points on the discount rate, and for automobile loans, for many consumers, they have actually risen slightly more than that. And if you weren't paying attention yesterday because you were enjoying the conference, actually interest rates shot up quite a bit. Mortgage rates are at a 7-year high. It's really, you can officially say the era of low interest rates is over. And there's no question that those low interest rates helped us sell more vehicles and get more people into automobiles just a few years ago. Now that becomes a bit more of a headwind and more of a challenge. But it's interesting, if you look back historically, and you may not have looked at a chart like this before that shows you what new vehicle sales look like inside economic expansions. The gray vertical bars are when we've had recessions going back to 1980, and the white space is basically the economic expansion period, like the very long one we're presently in. But if you notice, within that white space, in every expansion, new vehicle sales tend to go up and tend to come back down. And the blue line that I've put on the chart helps you to really see what that pivot point is. And that blue line is a rough estimation that my team makes around what the fundamental demand for new vehicles in the United States should be, all other things being equal. So we're looking at population growth, licensed driver growth, the amount of vehicles in operation and the amount of scrappage that's occurring, and you basically end up with a number today that suggests 16 million would be the natural rate of new vehicle production. Well, we've had several years of almost 18 million new vehicles produced and sold in the United States. And to make that happen, you have to have perfect conditions like extremely low interest rates, looser credit, much lower lease payments, and those things were favorable in 2014, 15, and 16, but are now starting to work against us. But there's actually a positive view of this chart. History tells us that we are not likely to see new vehicle production fall under 16 million units unless we have a recession. It's just a simple part that we call the post-peak part of the cycle that we're in, and it means that manufacturers have to get more targeted on what are the units that are most in demand and focusing on that activity. And we'll focus on that and how it relates to the Southeast in just a minute. And when we're in this part of the cycle, what becomes more important to keep the volume of new vehicle sales propped up are incentives and discounting. And this chart shows you what the incentive trend looks like. That's the blue line. And then the green line shows you effectively what the discount is when you compare the actual transaction price consumers are paying relative to the MSRP of the vehicle. But do you notice something, that when we got to this summer, that green line did a rebound and started coming back up, and the blue line stopped growing? Basically, retail demand this summer has been incredibly strong. The months of June, July, and August, and we're still trying to figure out the retail component of September, basically indicated that even more consumers were interested in jumping into the market, especially even relative to the first 5 months of the year. And as a result, OEMs have been making more dollars per vehicle on the vehicles that have been sold over the last 3 months. And that's a very interesting part of the cycle that clearly reinforces the view that consumers have not decided that now is not a good time to buy a vehicle. In fact, just the opposite. They really seem to have said this summer was a fantastic time to get ahead of even higher interest rates. As a result of that, we're seeing the supply levels actually moderate. We were in a bit more dangerous territory from a days supply perspective last year. We've seen that days supply come down a bit. It's still not out of the woods territory, but most interesting is if you look at the days supply for cars, and those are the things that haven't been growing in this market: sedans, mid-sized cars, compact cars, luxury cars. They've all been the segments that have been under pressure. And interestingly, the days supply in cars was 56 days in September. We haven't seen that number in more than 4 years. So it's clearly the reduction in cars have really put that inventory in balance. Now, speaking of that shift in cars, the chart on the left here is showing you what the percentage of vehicles sold by year, and the numbers for 2018 are year to date through September. So we've had a complete role reversal with SUVs really becoming the dominant vehicles sold in the United States, and that's as a result of the rise of the crossover. And we've seen correspondingly a massive decline in cars, which are currently at 31% of the market. In fact, in August and September, for the first time in history, the share of new vehicles sold fell beneath 30% in each of those months for cars. And so a key question many people are asking is, how low can this go? Is it going to go all the way to zero? And I actually thought that 30% would likely be a floor or close to it. It's really starting to look like, from price signals that we see in the used vehicle market, that trend is likely soon to reach its bottom, and the declines in car sales are likely to no longer decline relative to SUVs in a few months. Now, contrast that with what happens in the wholesale market, which you see in the chart on the right. This is the percentage of vehicles using the exact same segments for what we sell at Manheim. And if you don't know what Manheim is, we operate about 80 auto auctions across the United States. We touch over 5 million wholesale vehicles a year. It's a substantial view into what's actually selling in the wholesale market to feed used car sales. And you can see that cars still dominate. Year to date, they're still over 50% of the vehicles sold in the wholesale market. They are starting to decline somewhat, but it's going to take about 3 years for the wholesale market to look like the new vehicle market. So that means we're going to see differences in price performance, especially if cars are unloved and SUVs are all the rage. And that's actually why, with confidence, I can tell you I don't think that cars are going to continue to decline, because the best performing cars in the used vehicle market this year have been cars. Compact cars in particular, and mid-size cars, which again speaks to there's real demand out there, and perhaps some of the declines in production coming from the manufacturers, including big ones like Ford, announcing that they're exiting the space entirely. could be that we've seen enough production to get that market much healthier than it has been for years. Speaking of used vehicle sales, as I mentioned, when you're in this part of the cycle, basically the decline in new vehicle sales gets entirely met and then some by growth in used vehicle sales. That's because we have incredibly low unemployment. We have extremely high consumer confidence. So consumers have jobs, they need to get to their jobs, they have the money, in most cases they have the credit, but maybe because of higher interest rates, they can't quite afford the vehicle that they could have gotten in the new vehicle market a few years ago, but now there's ample supply in the used vehicle market for them to get. And in fact, this year we reached a peak this summer in annualized pace of sales in the used market of 39.5 million. We do think that we're at that peak and not likely to see it grow because the used market can only sell what it has, and because of the declines that have been happening in new over the last 2 years, it is inevitable that the wholesale market and the used market is also entering a period of plateauing and not likely to grow anymore. As a result of strong demand and supply that's no longer growing, we're seeing incredible price performance in the used vehicle market. That's not the Loch Ness Monster jumping up at the end of the chart there. That was the impact of hurricanes this time last year for that first rocket ship. Then the prices corrected back down after the frenzy ended. And then you see what happened this spring and summer. Truly, consumers felt urgency with regards to buying a vehicle because they are hearing in the news that interest rates are going higher and are up dramatically. They are hearing that tariffs could drive up vehicle prices, and I'll share with you some stats on that. We think that that's entirely behind why we've seen this incredible growth in used values. And why that's relevant for the new vehicle market is because, well, number one, it keeps the pricing of new vehicles stronger because those two markets have to remain in balance. But number two, the values on used vehicles influence the retention values or the residual forecasts that are the key component for setting lease prices for new contracts. And this chart from Kelley Blue Book is showing you that this year's retention values are over a full percentage point, close to 2 full points above the last 2 years. And as a result, we're starting to see residual forecasts now for future contract values of leased vehicles go up, and as a result, lease payments are a bit more attractive now than they were earlier in the year, despite higher interest rates and despite higher vehicle prices. And that's important because leasing makes up about 30% of the retail new vehicle sales in the country. Well, if you don't want to listen to the Economist talking about data, how about listening to dealers? We do a survey every quarter of dealers and what they see is happening in the market. And one of the questions that I like to focus the most attention on is an open-ended question where we ask them to identify all the factors that they say are holding back their business. And this chart is showing you comparisons for this last quarter, which we collected the data in August, versus the quarter before in the spring, which we collected in May, and then the same quarter last year in 2017. So what you're seeing is that they're actually this year seeing a decline in the number of dealers saying that market conditions are a problem, and for the first time, the number one issue became limited inventory. So their key problem is a supply problem that they just don't have enough vehicles to sell, and that includes both in the new vehicle market and the used vehicle market as supplies both start to contract. You also see that they're complaining about expenses growing up, and if you think about it, those higher interest rates impact their floor planning expense, their capital expense, their payroll expenses going up because of wages going up. It's truly a scenario where the costs for a dealer are going up all across the board. And then finally, the thing that's moving the most, focus number 6 on the list at 17% is interest rates. But compare that percentage to just a year ago where only 7% of dealers were saying interest rates were a problem. There is no question that that is really impacting them both in terms of the cost of their business, but also in terms of the consumers that they support. And so we basically have a supply challenge and a demand challenge that reinforces the view that we can't bank on the vehicle market seeing growth in this part of the cycle from this point forward, but it's very likely that we're going to continue to see a stable level of activity. There's one more wild card that was radically thrown onto the scene this summer. In particular, just at the end of May, President Trump announced that he was going to pursue using a Section 232 claim to impose an auto import tariff on all imported automobiles and parts that aren't subject to a free trade agreement. Today, that percentage is 2.5%. 25% is an enormous change in that percentage. And in fact, we think that started to influence dealer behavior this summer as well as consumers. So in our survey this last quarter of dealers, we asked them if they thought that the tariff implementation, just the concept of any new automobile tariffs on parts and or on some or all vehicles imported would have a positive or negative impact. And franchises, the majority, 56%, said it would have a negative impact. The independents were a bit more mixed because all they sell is used vehicles, and they actually think in the short term they could benefit from used vehicles being more demand, so they didn't quite have as much of a negative view. But then the table on the right tells you why they're concerned. It's all about prices. So if we've already got an affordability challenge and now prices are going up for all types of vehicles, and it's not just imported vehicles, they think it's going to impact all new vehicles because of parts, steel, for example, going up, but also that cascades into the used vehicle market. And sure enough, we surveyed consumers in August, and consumers clearly tell us that they are paying attention to the news about tariffs. It's actually influenced decisions for the people who have bought this summer. And so what we think is happening is a sense of urgency that if you're worried about affordability and you're paying attention to what's happening with prices and interest rates and the threat of both being much higher later in the year, then you very likely are thinking twice about postponing a purchase. So that's part of the reason why we think this summer has been so strong. And the good news is manufacturers and others have been taking advantage of this to reduce supply. Why are imports important? Why is the discussion of trade important? Is because our new vehicle market is highly dependent upon a global supply chain. But what's interesting is how differently those countries are by segment and just how important imports and exports are. This chart is showing you what the new vehicle sales in the United States have looked like by segment and by the country where those vehicles come from. And what you end up seeing is that, okay, 47% are imported, almost half are imported. Of that half, almost half of that comes from Canada and Mexico. But when you break it down into the segments, you really see that we have three segments that are heavily domestic. And when you throw Canada and Mexico now back into the mix of being North American domestic, then you have a scenario that pickup trucks have no imports. The mid-size car is a much more higher percentage produced just in North America. And then we also see the SUV, which because of weight and other issues effectively connected to the pickup truck production means that the majority of them are also produced in North America. That leaves us with three segments that are heavily imported. The most popular segment, crossover vehicles. The most affordable segment, compact cars. And then the segment that most people would think of principally because of European and Japanese models in the luxury segment. So the implications are not going to be consistent by segment, and of course this doesn't even get into the parts and components that go into the vehicles that are even assembled in the United States. So there is no question that changes in tariffs are going to lead to some higher expenses. The negotiated deal announced this week for the USMCA, sounds like YMCA, but the USMCA, basically will lead to a scenario of stronger North American production because we have higher content rules that are now in application. We have wage rules that will principally apply to the vehicles being assembled in Mexico. And when you think about that map and where pickups and SUVs are located, we're probably going to see a reinforcement of units produced in the more affordable areas of the United States, like the Southeast. But as you look at it by brand, there's an amazing distribution of just which makes are more domestic and which makes are not. This incredible continuum from Tesla being 100% domestic to 19 brands that are 100% imported. So the brands that are produced in the Southeast United States fall in the middle to the other side of the chart, meaning that those manufacturers are going to be in a relatively better competitive position as a result of this focus on the new trade agreements. But as we look in, and I share my forecast with you on this chart, to reiterate that we are expecting this year to be a decline from last year, next year to be an additional decline, but we're still expecting new vehicle sales to stay robust from a historical perspective, well above that 16 million line that you saw on the chart earlier. But we are also believing that the used vehicle market is no longer going to grow, principally because of the supply base. So as I mentioned to you, I wanted to share with you some interesting insights about the vehicles that are produced in the Southeast and the 6 states that are represented at this conference, based on where they get sold and registered in the United States. So using the 12 months of sales and registrations ending in June of this year, this is a heat map of the United States of where our southeastern vehicles go. And the table on the right shows you what the vehicles are and where the plants and what percentage of the country's new vehicle share they're representing. It's 18% of the US vehicles sold are produced in the southeastern states in the United States. Now, interestingly, if you're worried about an economic cycle unfolding and it happening regionally, there is a reason to be concerned, because 10% of the sales in the Southeast coming from southeastern vehicles are in the state of California. In fact, there are 3 states, California, Florida, and Texas, that are responsible for almost 30% of the vehicles that we produce in the southeastern United States. The southeastern states are the ones highlighted in blue on this chart. But I like adjusting the math a little bit more to look at something more interesting, and that is, what the sales in the individual states represent from a share perspective relative to the national share. So our national share, as I mentioned, is 18%, and that's that red line, dotted line you see across there. So every state, including all of the southeastern state that's above that line, basically sells more southeastern vehicles in those states to the consumers that are in those states. So in other words, who's from Mississippi in the room? All right, shout out to the Mississippians. You respect your vehicles being made, because Mississippians are almost 45% more likely to just buy vehicles from the southeastern United States and not from the other places in the world that those vehicles are produced. But the good news is every single state in the Southeast, every blue bar is above that red line. Collectively, we're about 25% more likely to buy our own here in the southeastern United States. But also take a look at the chart and realize, especially during football season, that you kind of have to root for Oklahoma, because for some reason they buy our vehicles almost as well as Mississippi does. And there are a few other states that, annoyingly you're going to have to root for. But clearly all of our states do a fantastic job of selling our own. But what about the composition of the vehicles? Well, we produce every segment in the southeastern United States, but we are heavily weighted to 2 segments. Crossover vehicles, the most popular vehicles, the vehicles that continue to be the focus of growth for OEMs across all spectrums. But we also have an outsized share of those mid-sized cars that I mentioned to you as one of the segments that's heavily domestic. And so this is how those numbers break down by each state as well on the right. The reason why I bring that up is that decline in cars also impacts us. This is what the trend in our car sales have looked like, not just cars in total. And it's why it's vitally important to understand when we're going to reach the floor on the share of cars no longer declining and which those vehicles represent in the Southeast. But it's almost the exact opposite that we see in trucks and utilities that are produced in the Southeast. We continue to see phenomenal growth. And when you look at the volume of trucks and SUVs that are produced in the Southeast, these are some really exciting vehicles that represent the best that the industry produces, and actually some exciting new model launches and refreshes that have been occurring this year and expected to come next year. So, as any economist is going to do, we're always, the joke is you want to speak to a one-handed economist, because they're always going to tell you something positive and always something negative. That's the reality. I'm truthful about our traffic. I'm truthful about our situation, but I'm thankful to live in Atlanta and Georgia and to be a part of this industry here. And I think we're in very good standing if we can continue to focus on how these trends are playing out and what's going to support the manufacturing that's going to deliver the vehicles that consumers want and that consumers can afford for the future. Thank you for having me today, and have a great rest of the conference.